Welcome to the Private Equity Exchange, the only summit bridging the gaps between limited partners, private equity funds, corporate executives, and entrepreneurs. With over 1,000 delegates, the Private Equity Exchange is the only venue where LPs, private equity firms, corporate executives, and entrepreneurs meet. Before the events, using our internet platform, schedule one-on-one meetings with delegates that matter most to you, and exchange far more than business cards at your deal meetings at the Private Equity Exchange. Gather great market insight with over 120 speakers and 6 tracks to choose from. The Private Equity Exchange, the largest private equity event in Europe for CEOs, funds, and LPs. You are looking at LBO for professionals, managing portfolio companies' new boundaries, 100-day plan and beyond, internal consulting practice, and operating partners. Introducing
So we're going to talk about, I think, a very interesting topic today, which is the 100-day plan and what needs to happen post-closing in a deal. We'll talk about a little bit what needs to happen following that 100 days period. Why is that interesting? Is that because it's probably something that, from a pure trend perspective, is something that has shown a lot of changes in the past few years, especially in continental Europe. We see more and more private equity looking into what happens into the 100-day period, and same with the management team. I think everybody would recognize that it's very important to do the right thing in that time frame. I'll probably give you my consulting perspective into that, but I'll be happy for David and Russell to tell you more about what their views are on that as private equity actors. Let's start with just what are we going to talk about here. So I'll briefly introduce the post-deal context. What's that? And then move into why a 100-day plan, why a 100-day planning. Then how do we do it? How do we implement it? And I think, again, Russell and David will have their own views on that. And then we'll wrap up and conclude and open that for questions if you have. So let's start with the post-deal context. Basically, what we can see is that right after closing, there is a significant drop in the pressure for obvious reasons, actually. I think the teams have worked very hard during the due diligence process. That can be even increased in terms of stress by any vendor due diligence process that could have happened in before. And there is obviously also, during this pre-deal phase, the fact that a lot of the management has been involved in, replying to questions, providing information, and have probably been a little bit away from their day-to-day business. So when the deal closes, obviously, it's very important for them to go back to that. And on the other side, we can see that this phase right after closing is probably one of the most important in a deal. It's as important as being able to close the deal with the right price. Maybe David, you can talk about your perspective on why and how you've structured your team at Terra Firma.
This is one of the major benefits for having a big operational team actually working within a private equity fund. Just to give you some context on Terra Firma, we are a big LBO fund. We are at the extreme interventionist end of the spectrum, so we have a big operational team deployed on all the deals that we do. We have a very differentiated strategy, so if you've got a good business with a good brand, good growth prospects, excellent management, please don't bring it to us to sell it because we're not interested. What we want is what we call the big, the bad, and the ugly, and the broken. Basically anything that needs management change or strategic change or operational change, or sometimes a combination of all three, and that's really our sweet spot. So I agree with Frank. I think, at this point of the deal team is totally exhausted. There's lots of critical issues to be started on day one. You need to move up a gear, and it's very difficult for a tired deal team to be doing that. At Terra Firma, we have a deal team that has an integrated operational and financial resources. And right up to the point of completion, the deal is led by a financial person. And at the point of completion, leadership switches to an operational person who's been in the deal team, but in a kind of secondary role. And then they take the leadership on from that point onwards. And I think that kind of change of gear is how you really get momentum in the early days of a transaction.
It's obviously very important. Just do not plan to comment on all of these, but basically, what are the rules to make deals successful? How do you create value? There are very well known rules here. Focus, speed, momentum is a classic. The cultural barrier issues, the resources. How do you allocate that to the most important initiatives that you will drive post acquisition? I think all of these everybody would recognize is very important, and all of this, or most of that, needs to happen when you think about it after closing. So very much, just to summarize it, that workload around the deal doesn't stop at completion. It will stop or actually slow down after a certain period, which, let's say, for the purpose of that discussion, we'll call the 100 days. There are things that will happen after the 100 days, but most of the workload will happen during that 100-day period. I think we can move to why a 100-day plan. There are various reasons, actually, but among those, actually, the first one is to make sure you've got a rapid transition to the new ownership. Is what we call, sometimes the taking control phase. You need to make sure that as a new shareholder, you are going to implement the new culture or the new way of running the business or doing things. The second element is also probably very important, is very much alignment between management and also actually the private equity. Alignment in terms of objective and vision. Where do we want to be in a number of years? What is our what are our long-term objectives? And that 100-day plan will be actually a good way to have those objectives and that vision be one and shared by everybody in the process. I think it's very important, and we can recognize that. I don't know if you want to add anything to that.
Yeah, what I would say, Starwood Capital is a real estate firm, a real estate acquisition firm. We're actually set up very interestingly like Terra Firma on the asset acquisition side. We have an acquisition team, and then we have an asset management team that we will hand the deal to once it is completed. We have recently treaded in fairly unfamiliar ground where we came to France and without an office in France and completed the acquisition of an operating company. And so for us, there were a couple of dimensions of the 100-day plan. The first thing was a bridging cultural gaps. And we had several, because we had, on the one hand, an American-French business culture gap that we had to figure out how to manage and how to build trustworthy relationships with. The second thing is that we had the transition from a family-based firm, and though public, a real family, I guess they call it here patronage, patrimonial type of management plan, management program, to something that was much more professional investor-based. And the third cultural gap that we had to cross was we took a substantially unlevered company and we levered it fairly highly. Those three elements made it extremely important that we had professional advisors on the ground and that we understood the capabilities of the management team as we were to move forward with essentially a new strategic plan. The final thing is that capital right now isn't the only axis of competition, because there's so much capital in the world, and oftentimes the private equity world is now getting asked to bid on the contract. It was something that we had the benefit of when we sold the champagne business. It was something that we were in some respects on the opposite side of when we were bidding for Groupe Taittinger and Société du Louvre. And in that case, you are taking over companies with limited reps and warranties. You're taking over companies sometimes without disclosure schedules. And so the ability to deploy a comprehensive team on the ground at the company to avoid any surprises down the road, especially when you are in, you have bank covenants that are breathing down your neck, has been extremely important for us.
Yeah, I think I agree totally with Russell. I think just picking up on the cultural point that he made, I think it's pretty well recognized that if you don't make the changes happen in the first 90, 100 days, or at least start them, then they'll never happen. And if you're dealing with all these cultural issues, particularly cross-country cultural issues, at the same time, then you've got a very tough job on your hands. And really the 100-day plan is a framework that you can hang a major change program off and make sure that everyone in the business knows that things are going to be fundamentally different. And you're starting to send signals across the whole organization. It doesn't really matter how you do it, you've just got to make sure that you do it. The things are going to be very different. It's typically a hard landing rather than a soft landing. I think just one more point. I think the other thing about a 100-day plan is it's the kind of missing piece in the jigsaw. We've just had a lot of leveraged finance experts in the room talking about where debt multiples are going, and as they're getting to 9, 10, 11, whatever it is, then you basically need something to deliver against that. And I think that the 100-day plan is the missing bit of the jigsaw between the returns the bankers are expecting and the returns the company is making now. And it's the concrete piece of activity that's really going to change the company.
Thanks. I think we'll come back on what are the key elements of the 100-day plan. Just to come back on what has been said by Russell and David, I think it's, as I say, it's important actually to share the vision and to make sure there are no cultural barriers post-acquisition. But it's also important actually to be able, beyond that sharing of the vision, to be able to drill that down to very pragmatic things and be able to actually have an action plan set up, meaning things that will, be quantifiable, be visible, from the quick win aspects to the more medium, long-term, initiatives. Therefore, it has to be, every initiative has to be quantified in terms of cash, in terms of EBITDA, in terms of working capital improvement or whatever. And this is what will actually build the credibility into the structure that the vision is really actually converting into reality. And it doesn't necessarily take that much time. I think through the quick wins, you can very, very rapidly build actually, that credibility and convince everybody who's not been convinced before that you're doing the right thing and that you're implementing basically your strategy and your vision.
Yeah, there's another element of it. It's not only the credibility of the plan that you foresee, it's actually giving the teams the confidence to execute. We came into situations where, here especially, where certain basic processes of the company were broken. They weren't fixed. They weren't fixed for whatever reason. And it is very easy for us as leveraged investors, as American investors, to criticize a company for doing something or not doing something, as the case may be. But the opportunity for them to grab onto the quick wins and to see that the quick wins, they can execute quick wins and they can gain confidence in their own ability to manage their businesses and promote their businesses and get a cheer from their private equity sponsor very early on is very, very important as you continue to manage through the process. I mean, our 100-day process is still going on, so we're a little late. And thankfully, Paris has been a very kind hotel market. But it is very important to translate stylistic differences, to understand stylistic differences, to understand the source and the root causes of why basic things haven't happened, so you can fix it.
Thanks, Russell. Now, in terms of what is the content, or what can be the content of a 100-day plan, from that actually slide, you can see that it may actually cover a lot of different things. So it's not a question of addressing all of these. It's very much depending on the nature and the specificity of the deal. We've classified that at PwC into 5 main categories, but I have to say our experience is there are things that we very regularly see as being covered in a 100-day plan, especially in the first round of LBOs. You'll probably have a clear focus on cash, and therefore all of what relates to treasury, cash management, cash forecasts, and also reporting are very often part of the 100-day plan. And sometimes you've got much more than that in terms of working capital improvement, and you can dive into very operational aspects, which actually were the case at the Tétanger deal, Russell, in terms of getting into operations and understanding the business and the rationale.
It was a mess. I don't know. We don't know how to really. We had very few. Again, our diligence process was very stinted. It was very short, and it was very difficult at the time of the diligence process to actually understand what the structures of the various companies were. There were 5 companies in total. This is a budget hotel business, a luxury hotel business, Baccarat, Champagne Taittinger, and Annick Goutal. And from the outside, you assume that basic things are getting done, and from the inside, we saw that it was in fact a separate case. At our budget hotel business, for example, we had no revenue yield management system, we had no property management systems. Impossible to tell from a series of financial statements. And so what we did do very quickly is one of the first moves we made is to bring in a CTO to help us with the deployment of a property management system for the budget hotels across owned, managed, and franchised assets. And that was completed actually fairly quickly within 6 months, and the hotels today can compete against the core with a fairly safe, with a fairly good mind. Our revenue gap, our RevPAR gap with the core had widened over the years. And if you know about the hotel business, we should have at least been able to keep pace, but we didn't have real information to be able to do that. So as Franck said, getting the hotels up to speed, investing in the technology infrastructure was very important. At the same time, we had a closing procedure on our financial reporting, which was 45 days after the month, which meant that the information was completely useless. And working with PwC, we were able in a very short time, I think within 3 months, to change our reporting system to be able to close and be able to focus on it. Again, what we needed for our banks, what we needed to make smart management decisions is as close to real-time information as we possibly could have gotten. And thankfully, we were able to do that through our 100-day plan.
Yeah, thanks, Russell. I mean, like Russell's business, we really like messes. So this kind of situation, I wish we were the underbidder on Starwood, so I wish we'd got it. Sorry, not on Starwood, on Tétanger. I think just to make a couple of points, I think one of the most important things in a 100-day plan is to stop doing a lot of things. And it's clear that focusing on the important things is right. But I mean, for instance, at Tank & Rast, which is a big German motorway service station company we bought at the end of 2004. The business had 40 priority projects that it was undergoing at the time when we bought it. And I don't know about you, but I can't have 40 priorities going on in my head. I mean, 2 is a stretch for me personally. So stopping 32 of those was one of the most important things that we did. And, we actually set up notice boards around the company showing that 32 of them were losing money or had a 15-year payback and so on. And people could really buy into the idea that actually you only need to do a few things well to succeed. And doing 32 things badly or creating a bad return isn't a very good way to start doing that.
Can I let me just add one thing, because we had a similar experience. It's one of the most difficult transitions you can make. Because the reason those 40 things were on the agenda is because the management team thought they were good to put on the agenda. And so the using outside experts and committing yourself to actually working side by side with the company, anytime, as my brother calls it, putting a net on CapEx to understand what it is that you're actually doing, that has a complete down throttle effect on the business. It can be very demoralizing. And so your commitment, the sponsor's commitment, and the outside commitment from outside experts to reinvest their time and their energies and their efforts into this business is a key part of being able to bring this company back up from the down throttle.
Let's move to how do we implement 100-day planning and what happens beyond that period. Just as an illustration, I think what is actually a process of 100-day planning, really. I think it starts with all of the pre-deal input that you can have from actually your strategy, from any elements you've put into your business plan in terms of initiatives, whatever has been identified through the diligence process is actually an input into the plan. But not only, actually, that's one source of input. It's also being able to challenge whatever you have estimated pre-deal. And during that 100-day planning phase, as Russell and David have started illustrating, I think it's very much, focusing on the priorities. What are really the priorities? Not 40 projects, but how much, 5, 10, and what is the time frame for each of those? And then, what are their value, basically? Is that value creation, really? What are the risks associated with that? Are we going to be able to implement those? Do we have the resources to do that? And then, okay, if yes, then let's put that on the agenda for whether the next 3 months, the next 6 months, or whatever, and let's make sure we're going to monitor how we deliver on those objectives. So it's a limited number of initiatives, and you can see actually it has to involve not only management but sometimes staff. It has to involve operating partners. It has to involve sometimes experts, sometimes consultants. So it's very much around workshops, and basically these phases here do not take a long time from our experience. It's probably once you've kicked off the project, it's probably a few weeks, okay? And then it is very much refining some of the plans. But you can go through that 100-day planning phase from 2 months to probably 4 months. That would be the time frame actually. And then what are the results of that? And I'm sure David and Russell will comment on what's the content, but in the end you have to have pragmatic things actually, really a plan, because a 100-day plan is a plan by definition, with tangible initiatives, valued, quantified, to cash, a clear timeline for each of them, and then a team to implement. David, you want to talk about your methodology and how you build those plans?
Yeah, sure. I think one of the critical things for us is that our operational plan drives our financial plan and not vice versa. I think very often sponsors have a structure where the financial plan is created to win the deal, and then the operational plan is created to deliver the financial plan. And clearly there can be a gap sometimes. I think in our business we start with the operational plan and see what we can afford to pay. And what that means is on day one you've really got to have a very detailed operational plan ready to deliver and to deliver the financial results. And I think it goes down to extreme levels of operational detail. So we would typically spend 12 to 15 months doing operational due diligence on a business before we buy it. Occasionally you're in a situation that Russell mentioned where you have to truncate that, but the ideal would be 12 to 15 months. And in that time you can get to know a business so well. I mean, for instance, in Tank and Rastigan, we knew that 71 of the 350 stations were losing money, and we knew exactly why they were losing money, and we had a plan for what we were going to do on day one. It goes down to that level of detail in terms of what you're actually prepared to do. And I agree with Frank, you need a big team, and you need a team with a lot of different skill sets, from people who understand the political environment you're operating in, people who've got specific functional skills, and people who are just going to get on and do it. And so I firmly agree with what you said.
I think one of the other interesting points about the 100-day plan, as Franck brought up, was how do you staff it. You cannot divorce the sale process from how you actually act afterwards. Are you participating in an auction where everybody in the company knows about the process is one type of a deal that you're walking into? We walked into a transaction where the company was essentially sold against its will. It was sold by the Tadenjay family, and my CEO of the hotel company found out fairly late in the process that the business was for sale. And so the importance of that is that the organization hasn't had a chance to ready itself, and your need to staff down into the organization so that the middle management teams and their reports can actually gain confidence in who you are is actually very high. It is also interesting, something that we learned as we did this here, is our focus immediately was on the hotel group because it was the largest portion of the value of what we ended up buying last year. But for the folks at Baccarat and for the folks at Champagne and for the folks at Iniquotal, their world was their world. It was their most important world. I think something that we would actually probably do differently that we didn't have a chance to do last year is not having had all the focus on the hotel company, but go out, get a team, and actually deploy it to some of the other subsidiaries, specifically Baccarat in our instance, because it's a very sensitive situation. The Champagne business has been run very capably for 45 years by Claude Tattinger, and he actually had a very steady hand, and I think he actually trusted us. So two things, the nature of the sale process you're involved in, which will dictate how and who you get involved, and secondly, don't ignore the other parts of the business because they actually are very, very important to the people who run those businesses. That's it.
Thank you. Just to come back on that priority aspect, I think in that Tétanger case, Russell, it's fair to say we had identified about a year ago, just after closing, about 10, 12 key initiatives that needed, some action. It was not a question of, starting all of these initiatives just up front. It was more just putting them into, their respective timeline. So again, it comes back to what are the resources, what is the right timing, and what are those that I need to do now versus in 6 months or in 12 months' time. And when Russell said earlier in that discussion, we're a bit late in the 100-day plan, it's not that they're late. To me, it's more that they are addressing some of these initiatives only right now, and there are a couple of them which will probably be addressed a bit later. But that's very much in line with what that illustration says, is you absolutely don't want to do 40 projects in parallel. You just want to do things at the right timing and based on the priorities. And the matrix here is what is the value, obviously, and what is the ease of implementation. Do I depend on, external factors, market, whatever, that I don't have a grip on, and therefore, if that's the case, how can I make sure I'm going to drive value and really implement my plan? So everything is an assessment, but in the end, once you've decided to run it, just go for it, which means resources, monitoring, communication. Briefly, same with the timeline. I think it's very important to make sure you've got a very strict agenda, deadlines and timing for that, or milestones. What you see is a typical, let's say, 100-day planning phase. You'll see the major blocks being, 100-day planning as such, with the urgent action, things that you need to do to take control from the value drivers. What are the key initiatives that I'm going to identify? The business reviews, the operating style analysis we talked about earlier. But there is also points around management. Are these people, and we'll come back to that in a minute, are these people capable of driving these initiatives and delivering the value, and if not, how do I do it? Well, again, we'll come back on that. And there are two big pieces. Communication is key, because that's what will drive everything into the same direction. Everybody will be motivated and clear on why things are done like that, and will then contribute. And there is a big project management aspect attached to that, because the more complex, the more structure you need. I think the implementation phase, actually, we're not addressing in detail here, has to be monitored, and this is probably where David, you can talk about how you follow up and how you monitor delivery beyond the 100-day period.
Yeah, I think that's right. I think you've really got kind of two changes of gear. If you take Franck's chart, I think the 100-day plan itself needs to be written in detail kind of before closing so that you're ready to go on day one. So there's kind of a phase before that. And during that phase, we're typically communicating heavily, often through the media, as that's the only access that you have, about exactly what you're going to be doing and trying to get people in the company to understand what you're going to be doing before you actually get in there. I mean, just to give you an example of a big German residential housing company we bought just over a year ago, we'd made so much noise about job cuts in the media that when we met the unions on day one, they actually offered more job cuts than were in our financial plan. So that can be a very useful kind of preemptive strike on the 100-day planning process. I think, I agree with Franck on what he's been saying in the first 100-day plans. You've got to be realistic what you can actually achieve in 100 days. It's about setting priorities and getting projects kicked off. I think in the second phase, that's when obviously the value is really driven, and that's when we switch gear from having an enormous SWAT team of 15, 20 people in the business basically making a lot of noise to having very focused project leadership against initiatives that are really going to deliver the value, and kind of that tends to be where we reduce the size of the team and leave one or two people, such as myself, leading individual projects in conjunction with the CEO of the business.
We talked about management, working with management, eventually adapting management. There are various cases here. But first, I guess it starts with an assessment of the quality of the management team. And I'll probably pass the word to Russell and David quickly on that. How do they do that? But also then, how about adapting or strengthening the team? What do you do? How do you do it? What type of solution can you find there? And also, we'll probably talk about how you work with management on a day-to-day basis, short and long term.
An acquisition is a period of wrenching change for a company, and it is nobody's fault that the company was sold, and your new shareholder may have different plans than the existing team or the existing owners. We had the great fortune of buying a series of absolutely fabulous French treasured brands, and we had thought that they were underinvested in, and we thought that they had better growth profiles than they had demonstrated in their recent past. We were not an information-rich company, and one of the difficulties we have in the first couple of days, you have your assessment of your management team that you can choose, and you have your assessment management team that's chosen for you. So within 60 days, we had our CEO leave the business or announce that he was leaving the business, and we had to act. But it's very important that you don't, it's difficult to judge the quality of a management team when the management team does not have the proper tools that they need to manage their business. What you can assess very early on is you can assess whether that management team is tactical or whether the management team is strategic. And are they about incremental change or are they about sea change and how you grow? And you know very early on as to whether or not it is consistent with your beliefs. In most of our organizations, we usually change the top financial officer. Normally because in this case, we had a financial officer who was not used to a leverage situation, was not used to firm reporting metrics, and it is very difficult to adapt on a dime's notice with that. The other thing that is very, very important is we don't have the fortune of having an operating team from Terra Firma that has been instilled with the culture of Terra Firma. We have to use outside advisors when it came to corporate diligence. And as you look around and you talk to and interview experts, you have to make sure that culturally your experts are actually on your plane, because they will do more damage to you if they are not. And if they don't represent your company right, then they will help you. We spent our pre-diligence period working with the PwC transaction team and felt very, very comfortable with them to move into that 100-day plan. Because they're your extension, they're your arm, and they're your face when you're not there, and everybody needs to get along because everybody's looking at them as our guys. It is incredibly important to recognize the human element of that first 100 days. You have what you need to get, but recognize that on the other side of the table there are humans who are giving it to you, and you need to figure out the best way to get it out from them, be disciplined about it. But there are elements that crop up that are either unpredictable or that you can create for yourself that you need to avoid at all costs.
I think that's right, Russell. I think at Terra Firma, we like to say we're management agnostic during a deal process, so we're kind of open to being convinced. But from a statistical point of view, we've replaced 17 out of the last 19 CEOs of companies that we've acquired. So people are starting to get a little bit skeptical about the agnostic bit. I guess, the truth is we're typically buying things that are fairly broken, and you're unlikely to find people running those companies who have the capability of turning them around and seeing what the problem was, just didn't get enough support from XYZ. It's kind of hard to believe. So we typically have one of our own team going in as acting as interim CEO whilst we recruit the new CEO. And we're starting that recruitment process earlier and earlier in deal processes now. Partly from a competitive point of view is that, there's a pretty small pool of talented CEOs out there, and, our competition are doing exactly the same thing, giving exactly the same job description to a similar group of headhunters. And it's really a fight to find the right talent to run these things. What that means is you've got to have the capability to run the company while you're recruiting the new CEO. At Odeon and UCI Cinemas, they were two companies that we bought in separate transactions, coincidentally on the same day. And we were not allowed by the regulator to merge them for 6 months. And that meant we had to deploy 2 interim CEOs and 2 Terra Firma SWAT teams, which weren't allowed to talk to each other for 6 months while we recruited the new team and were allowed to merge the business by the regulator. So I think in terms of management, we're probably unusual in that we typically don't back management in the businesses that we buy, but we absolutely recognize that it's one of the most important success factors.
Something that Franck referenced, which is also important, is that we have learned is the internal and external communication of what is going on. Our 5 businesses share several unions, and the unions do talk to one another, and the unions do see one another. Again, it's something that we learn as we operate in a foreign country, really for the first time with an operating business. And you need to over-communicate. You don't need to over-communicate the content, but you need to over-communicate on market rumors, and you need to settle people down. We're in the great fortune of having some precious assets that people want to buy, and nothing is for sale. And the agenda is not necessarily going to be set for you. And it's very unsettling. Again, if you go back to our the cultural gaps that we're trying to bridge, people are trying to learn to trust us. People are trying to learn to believe in what we say, and there are unsettling rumors out there all the time. It is very, very, very important to look people in the eye, tell them exactly what is going on, to try to be communicative during this process, pardon my language, because if not, you will lose people. People will stop working hard, people will not do their job well, and people will look for other employment, and you'll find yourself set back at a time that you're really trying to move the businesses forward.
Just to wrap up and conclude on this presentation before we move to any questions, I think we mentioned earlier there are actually 2 aspects into the 100-day planning benefits. One is very much cultural, and making sure you've got business objective and priorities aligned, the momentum, the aspect of coming together as one team to deliver the value. And also on the other side, I think it has to be very pragmatic and really measurable, quantifiable, making sure that you will actually deliver your business plan. You will eventually actually deliver a bit more over and above your business plan. And the 100-day planning is actually here to make sure that you will start delivering the value earlier in the process, i.e. you give all of the chances to, reach, eventually exceed your year 1 target. So that's very much the beauty of that exercise.
Yeah, I'd agree. I think, it's about creating unstoppable momentum for change in the organization, and then finding a way to get yourself out of it and letting the management run the business.
Any questions actually on?
You lay the emphasis on the importance of the choice of the experts, before the acquisitions. And from my experience point of view, sometimes the choice you make for the experts in the pre-acquisition phase couldn't lead to maintain then for the post-acquisition, because sometimes you don't need the same kind. And you feel this guy is quite an expert to deliver to you some good information and good analysis and diagnostic on the business. But should it be the person to implement that afterwards or to advise you afterwards in the post-acquisition plan? And I'd like to share with you your experience in this field.
Yeah, I do agree with you. I mean, I think when you have people who have very strong analytical skills, they often don't fit into the company post-acquisition. And very often what we do is we use firms such as Franck's very heavily pre-acquisition, and then post-acquisition we'll continue using them, but in, I guess, backroom roles where they might be supporting the program office, which is kind of the center of change, very heavily. And they may be tracking benefits and measuring KPIs very heavily, but we'll have very little interaction with people in the business themselves. And we've found that works better than having the same kind of very analytical team post-acquisition with working with people who don't necessarily think in the same way.
I would say that acquisition situations are unique. And what we had happen at SDL, at Société du Louvre, is we were still traveling up a learning curve when we originally signed the business. So we needed to continue on that learning curve, and starting over with a new firm was not the right thing to do. It would have prolonged the 100-day period. Now, had we turned, we are fairly comfortable in the hotel business, and we had a strategy for the hotel business that meant that we didn't need somebody from the outside. In, for example, Baccarat's case, which wasn't 100 days, but just to give you an idea, it was more of a strategy issue. PwC was familiar with the firm, and we actually worked with the management team, brought 3 or 4 companies in front of the management team that we were fine with, and let the management team choose who they wanted to work with. So one of the questions is, as David sort of put it, are you putting people more on the backroom area or more on the process flow of the business, or are you moving people more into the strategic flow of the business? I would echo with David, if we were not sure what we were going to do on the strategic side, we may have moved in a different direction. But for now, we didn't need to do that.
Yeah. Just my perspective on that, I think you're right. At PwC, at least, I can say we do not necessarily intend actually to act as an operating partner. What we try to do is actually give our advice in pre-deal and start looking at around the transition phase, act as a facilitator, use our knowledge of the issues of the people to actually accelerate somewhere the 100-day phase. Then we can be an expert in some areas as PwC, on a specific project, like changing some of the IT, for example, or dealing with some tax aspects. But we're not positioned right now to be the firm doing all of the pre-deal, of the post-deal, and it's certainly not the case. We try to involve experts in pre-deal phases because I think it's very important, beyond the analytical skills we have, to be able to bring some operational aspects. But that's it.
Just to clarify a bit the difference between the two models that I see between you two, I understand that, David, you're going to spend a lot of time beyond the 100 days plan to actually drive some of the initiatives yourself. You're not going to delegate that to PriceWaterhouse or someone else. And Russell, I was not clear what you were doing beyond the 100 days or whatever it is. But on the major change initiatives, what are you? Are you doing that yourself, or your team is doing that, or is it someone else?
We have operating CEOs of the business who we monitor. Right now, our operating CEO happens to be a Starwood partner, and it was more because Jan Callier chose to leave us than anything else. But the operating teams are working through their own problems, and they are prioritizing themselves right now. Everybody knows what the priorities are, be it at Goutal, be it at Baccarat, or be it at the hotel company. And we believe in managing those businesses through the CEOs with active oversight, not active management. So it is a slightly different mode.
I think that's probably where the slight distinction comes, and I think we have a belief sometimes that no CEO can do absolutely everything. And I mentioned we were doing 8 projects at Tank and Rust. Management are leading and running 5 of them. I'm leading 3 of them with support from the management and their teams, just because their skill sets historically haven't been in the particular areas of these kind of retail and consumer product projects that I'm leading. So we firmly believe with Russell that the CEO is there to run the company. Just occasionally they won't have the full panoply of skills that you need to do everything.
Yeah, and where we're active in the companies is in our core business. So development, it is actually our people who have been seconded to the company, who are working through the company, and trying to leave behind a legacy of learning, trying to teach people how, the Americans will look at an acquisition or look at a development transaction. We also unsuccessfully bid on a UK budget chain, and we were actually working side by side with the company to, again, show them how we look at an acquisition, how we will fund an acquisition, and to show them how we negotiate with banks. These have not been acquisitive companies in their past, and part of our imperative for growth will inevitably be through acquisition and through development organically and in new countries. But how you look at joint venture structures, how you look at pure development transactions, how you line up with partners, what questions you're asking about the partners, are questions that we've asked throughout our 15-year history that the companies haven't yet asked. So we try to be active where we can add value.
Russell, how did you deal with the French unions? And did you
dealing with French unions.
did you announce a lot of redundancies, or did you?
No, we haven't announced redundancies. Again, it is different with all the companies, and we have had some labor unrest at some of the assets, which has much less to do with us than it just has to do with the individual management of those assets. We have faced a strike at Baccarat this past summer. That actually had to do with an accounting issue from 2005. We believe in dealing with the unions very straightforward. We've asked them for the time to put our plans in place. We are slightly behind in some of our development plans for the hotel business, but our franchisees and our budget hotel owners will learn about our plans in the not-too-distant future. And at each of the luxury hotels, we are going through a business planning session, basically an asset strategy for each of the luxury hotels in conjunction with the management teams who are then communicating with their union reps. So we are behind in our development schedule, behind in our CapEx plan, mostly because it's taken longer to determine what we are doing and how we're doing it. We are unfamiliar with issues of buying back retail stores in hotels, which we thought a lease ends, it ends. We didn't know that there was ownership of a business attributed to the tenant. We are learning French zoning laws and learning what we can and cannot do. And at Baccarat, I think the union has given us a great deal of flexibility and want to know what we're doing, which we will be communicating again over the next 45 days. You may have seen the announcement in the LBO yesterday that we've called for an extraordinary general meeting on January 9th, and that we will be communicating our plans to the unions in an effort to expand the employment in Baccarat. So it's openness and refuting rumors that are untrue and trying to address what you can address if you can address it. If you can't, you say you can't.